Welcome to Lior Times. I am your global business correspondent, and tonight I am bringing you a story that has shaken every major stock exchange on the planet in the last 24 hours. The artificial intelligence bubble that has carried global markets to record highs for nearly 3 years is showing its first serious cracks. And the cracks are coming from inside OpenAI itself, the company that triggered the entire AI revolution. Stay with me, because what I am about to share will change how every investor, every entrepreneur, and every fund manager in the world thinks about AI exposure for the rest of 2026. Let me begin with the explosive news that broke yesterday. The Wall Street Journal published a report citing internal OpenAI sources, including Chief Financial Officer Sarah Friar. According to the report, OpenAI's recent revenue growth and new user acquisition have fallen below the company's own internal targets. Sarah Friar told leadership that she is concerned OpenAI may not be able to pay its massive computing contracts in the future if its top line does not expand fast enough. Just absorb that. The company that single-handedly created the most expensive infrastructure boom in modern technology history is now privately worried about paying its own bills. Let that sink in. OpenAI privately worrying about its own bills signals real strain across AI infrastructure. Investors should note the shift now. The market reaction was immediate and brutal. Oracle, which has a $300 billion 5-year partnership to supply computing power to OpenAI, dropped about 7.5% in pre-market trading and continued falling through the day. CoreWeave, the AI cloud computing company that has been a Wall Street darling, dropped 7%. Nvidia, Broadcom, and Advanced Micro Devices all fell between 2% and 5%. Qualcomm pulled back 3.5%. In Asia, SoftBank Group, one of OpenAI's largest investors, sank a stunning 10% in Tokyo. The S&P 500 fell from its record high. The Nasdaq 100 lost roughly 1%, and the Russell 2000 small-cap index, which had been rallying over 11% in 2026, fell 1.2% as investors took profit. Markets digest the shock. Index boards flicker red as risk is repriced, and AI-linked trades face the first true test of conviction. Now let me explain why this is much bigger than just one company missing its quarterly targets. For 3 years, the entire global stock market rally has rested on a single assumption: that artificial intelligence demand is unstoppable, that compute requirements will only grow, and that companies like OpenAI, Anthropic, Google DeepMind, and others will need ever more powerful chips, ever more data centers, and ever larger cloud capacity. Trillions of dollars in capital expenditure have been deployed across the world based on this single assumption. Microsoft, Google, Meta, Amazon, Oracle, and dozens of smaller players have collectively committed over $1 trillion to AI infrastructure between 2023 and 2026. If OpenAI itself is now privately worried about paying for that infrastructure, the entire foundation of this trillion-dollar bet starts to look fragile. The timing of this story is also important. It comes just days after OpenAI announced it was bringing its models to Amazon's cloud, formally ending its exclusivity with Microsoft. This was already a sign that OpenAI is desperately trying to expand revenue channels and reduce dependency on a single partner. Microsoft, which still owns nearly 1/3 of OpenAI, fell briefly on the news, but recovered most of those losses. The deeper market message is clear. The AI ecosystem is now openly diversifying, hedging, and de-risking. 2 years ago, this would have been unthinkable. Now let us bring in another massive voice that spoke up just hours ago. Jamie Dimon, the legendary CEO of JP Morgan Chase, the largest bank in the United States, publicly warned that he sees, quote, some kind of bond crisis ahead as global debt risks build. Dimon's warning is not random. He is connecting the dots that smart investors are also connecting. Massive AI infrastructure spending is being financed by debt. Sovereign debt globally has crossed all-time records. Interest rates remain elevated because of inflation from the Iran war. Oil prices are projected by Goldman Sachs to stay at $90 per barrel through late 2026, with Brent forecasts revised higher because Strait of Hormuz disruptions are proving more persistent than anyone expected. When the head of America's largest bank uses the word crisis, capital allocators around the world listen. Let me give you another data point that no other channel is connecting. The United Arab Emirates is preparing to formally exit OPEC, the cartel of oil-producing nations. This is a massive shift. UAE is a top global oil producer, and its frustration with production quotas is now visible in policy. If UAE leaves OPEC, the entire supply discipline of the cartel weakens. Oil prices could become more volatile, and inflation expectations move higher again. This pressures central banks globally, slows rate cuts, raises borrowing costs for AI infrastructure projects, and feeds back directly into the OpenAI growth crisis we just discussed. Everything is connected. Now let us talk about what this means for global investors watching from India, Southeast Asia, the Gulf, Europe, or Africa. First, The AI infrastructure trade, which has been the single best performing trade of 2024, 2025, and most of 2026, is now under serious reevaluation. Investors who concentrated heavily in AI-linked names are seeing real-time mark-to-market damage. Diversification, which felt unnecessary during the boom, suddenly feels essential again. Second, the broader technology sector is splitting into two camps. The hyperscaler giants like Microsoft, Google, and Amazon, which have multiple revenue lines, are likely to absorb the shock and recover faster. The single-thesis AI plays like CoreWeave, Oracle's AI division, and pure GPU-driven names are facing much more turbulence. Third, sovereign wealth funds and major institutional investors are quietly rotating into more defensive names. Energy, defense, financials, and selective emerging markets are seeing fresh allocation interest. Capital rotates from pure tech toward diversified defensive sectors across regions. Energy, finance, and select emerging markets taking fresh flows. Fourth, and this is the most underreported angle, India is structurally well-positioned. Indian IT services giants like Infosys, TCS, Wipro, and HCL Technologies are the long-term beneficiaries of any AI infrastructure normalization. Why? Because once the hype of building cools, the reality of integrating AI into enterprise workflows takes over. And that is exactly what Indian IT services firms specialize in. The next phase of AI is not about building bigger models. It is about deploying existing models inside thousands of corporate clients globally. India has the talent, the cost advantage, and the existing client relationships to dominate that phase. The OpenAI growth crisis may actually accelerate this shift because enterprises are now realizing they need pragmatic AI deployment, not endless model upgrades. Now let me share a final critical perspective. Markets do not crash when problems are visible. Markets crash when everyone has assumed something will keep working forever. 3 weeks ago, virtually every major investor on the planet was bullish on AI infrastructure. Today, that consensus is cracking. This does not necessarily mean a full collapse is coming. Most likely, what we are witnessing is the early phase of a healthy correction, where capital is being reallocated from speculative AI bets to fundamentally sound businesses. The bull case for AI is still alive. The technology is real. The productivity gains are real. The long-term winners are real. But the prices that markets are paying for AI exposure today are likely too high relative to the actual revenue these companies are generating. That gap is now starting to close, and that closing is going to feel painful for over-concentrated portfolios. The bottom line for every investor watching this video is the following. We are no longer in a one-way AI rally. We are entering a much more sophisticated phase, where understanding the difference between the AI builders and the AI users will determine investment returns over the next 24 months. Those who blindly chase whatever AI ticker is in the news will lose money. Those who study fundamentals, focus on diversification, and watch real revenue rather than narrative momentum will thrive. The era of easy AI gains is over. The era of disciplined AI investing has just begun. This is Lior Times. Clarity over hype. Stay disciplined, stay diversified, and invest with data, not noise. That is all for this edition of Lior Times. If this analysis added clarity to a confusing market, please subscribe to our channel and hit the bell icon. Share this video with anyone who has heavy AI exposure in their portfolio. In the comments below, tell me one thing. Do you believe the AI infrastructure trade is in a temporary pullback, or is this the beginning of a much larger structural correction? I read every comment, and your views shape our future coverage. Thank you for watching. Stay sharp, stay informed. This is Lior Times, your window into the global business world, from India to the world.